Hi there, this is Donna Bordeaux with Campground Accounting, and you are listening to Campground Compass, the show dedicated to campground owners in an entrepreneurial mindset who seek to grow and expand in the wild and wonderful world of business. Hello and welcome to Campground Compass, the accounting podcast, and for campground owners and wannabes. We have a special guest with us today, but before we get into that, I also have my co-host, Zach.
Hey, how y'all doing today?
Yeah, Zach Bordeaux is my son, of course.
And we're here with Bruce Hurta from Ameris Bank. How you doing today, Bruce?
I'm well, thank you. Thanks for having me.
Yep, we're glad to have you. Be a great guest and hopefully a great episode as well. So we'll just start out. Tell us a little bit about yourself and how you got into the banking and lending business.
Well, I'm an old guy banker, 45 years experience in banking and small business lending. I first got into banking when I graduated from the University of Texas at Austin with a finance degree, and my first job out of school was working as a bank examiner for the state of Texas. And
cool.
Since that time, I've worked for several different banks, including two small community banks in Houston where I served as president. And that's where I developed some of my SBA lending expertise and eventually went on to work for a non-bank lender out of New York that did SBA loans. And I spent 14 years with them. And during that time is when I first got interested in campground lending.
Awesome. So, we talk a little bit about we talk a lot about why the niche type thing is important for since we are campground accounting. We focus on campgrounds. We know what's going on with the different campground trends, not just general accounting. So what kind of makes you an expert in the campground industry, and why are you different than the average banker down the street?
Well, I was not an expert when I first got into it in campgrounds. My expertise was in SBA lending and small business lending, and the thing that got me interested was my parents. I grew up on a beef cattle ranch in central Texas, and I had parents that worked really hard developing cattle business and a real estate and land sales business, and they were pretty successful at it, and they worked really hard and rarely took vacations. And one day I noticed they bought an RV, and they started leaving Texas in the heat of the summer for a month every year. And I was so impressed by the fact that they would actually take a vacation, and they really got into the lifestyle, and it just was amazing to me that they would do that. And that was when I was working for the non-bank SBA lender, and they were encouraging us to have industry specializations. And I was hearing from people that it was difficult to get campground loans. Bankers were not familiar with the industry, not real experienced. And they were trying to put it into a credit box and make it fit a standard format for lending, and they couldn't do it because the campgrounds were anything from a mom and pop up to a sophisticated resort, and it was very difficult for them to get their arms around it. And so I thought there's a need there, and this would be a need that would be served well by a government small business loan program. And I started working in the industry first by joining and getting involved with ARVC, the National Association for Campground Owners, and that's probably where we met. And that was a really good launch pad because it's a group of professionals and owners who want to be professional, and I met a lot of people through that association and started lending to campgrounds and learning about it. And so I was with that company for a number of years before it went out of business during the housing crisis in 2008. And I, after that, went to work for a credit union in Houston building an SBA loan program. And to be a campground lender, I really needed to be in a national scope. And the credit union was limited to just lending in Texas. So I really stopped lending to campgrounds for 8 years while I was at the credit union. And 5 years ago, the credit union decided not to do business accounts anymore. They went back to a more traditional format for credit unions of just doing consumer accounts. And so I started looking for a bank that had an appetite for campground lending because I wanted to get back into it. And I found this bank that I work for now 5 years ago, and they hired me specifically to develop business in this industry, and we've been successful doing that. Not long after I joined the bank, I ran into all kinds of challenges with my credit manager who didn't want to do these loans even though I was hired for that. And then the pandemic came, and then all kinds of challenges, but the pandemic actually made this business grow. And so it actually worked out well. And to this day, I've been financing a lot of campground acquisitions, some startups, a lot of expansions, and partner buyouts and all sorts of things. And it's been a good business for me. Now I spend most of my time lending to campgrounds. I do a little bit of lending to other small business types, but the demand for campground financing has been so strong that it's been really good.
That's awesome. Now, I know one of the things that a lot of people get confused about is the difference between going for a loan at a bank and borrowing through the SBA. They seem to think that they're borrowing from the SBA, and that's really not the case. Can you tell us a little bit more about how you work with the SBA and what the SBA's role is in giving loans?
Sure. The U.S. Small Business Administration wants to encourage small business commerce, and they want to create jobs, and they know that by encouraging small business growth that will accomplish those federal objectives. What they offer is a partial government guarantee on the loan to a bank that participates in the program. So we follow all the Small Business Administration guidelines for small business eligibility, and we make loans according to their rules and regulations, and then we get a partial government guarantee on the loan so that if the borrower ever defaults on the loan, we can actually foreclose on the assets, sell the assets and try to recover any loss that might be on the loan. And if there's nothing left over after selling the assets and there's still a loan balance, the SBA will cover part of that loss for the bank. What that does is it reduces our overall risk, and it allows us to make loans on easier terms than conventional bank financing. It's also a different type of loan terms because banks by nature are short-term lenders. They have to stay liquid with their depositors' funds because they're loaning out their depositors' funds. And so most of their loans are on a short-term basis. Whereas when we originate an SBA loan, it's long-term permanent financing for up to 25 years. And that helps the borrower because they don't have to worry about coming back to the bank and renewing a loan that comes due every 3 or 5 years.
Yes.
Because of the reduced risk, we can also have a lower down payment requirement. So the combination of a lower down payment and longer repayment terms are the two biggest advantages of getting government-backed financing. But you're right, the bank is actually loaning the money.
The SBA is kind of like a little insurance policy for the bank to make sure you pay off your loan.
Mm-hmm. Yep. So, looks like we might have lost Bruce, but he will probably pop back in here in a second. But we want to take a second to remind you to make sure to follow us on YouTube, subscribe to the channel, turn on notifications just so that you can make sure that you don't miss an episode. And listen on Spotify and Apple Music. make sure that you leave us a review. It helps the podcast grow, and we're back to the regular show.
Awesome. Yeah, we got you back,
I
Chris.
lost you there for a minute.
That's all right. We got you.
We have a backup plan anytime that we might lose somebody. We always just go ahead and plug the show, make sure to tell people to write a review and whatnot. So we'll hop back into it. The next kind of thing that we wanted to touch on was like, when should buyers reach out to you in the process? Do buyers have to have like a specific campground under contract, or can they be pre-approved based on the purchase range, or a little bit of how that works?
The biggest challenge in the startup of a loan application is nailing down all the project costs. We really need to know what we're financing. And so a lot of times people will contact me before they start a search to buy a campground, or before they even realize what their development costs are if they're starting a campground. And that's fine. I'm happy to answer questions, offer guidance, parameters, rules, and so forth. But 9 times out of 10, if we're talking about a transaction that hasn't happened yet, the borrower really doesn't know what their project costs are going to be, and we really don't know what we're going to be financing. So when I send out a loan application checklist, one of the first things on that checklist is, if you're buying a campground, you need to have an agreement with the seller on what the sale price is. That might be an executed earnest money contract. It might be an LOI, a letter of interest, something where we know that the buyer and seller have agreed upon a price. If it's a startup campground or a business expansion, and most of the costs are related to buying land or construction costs or the cost of park models and equipment, then we need quotes from a contractor or from vendors, something, once again, to nail down the project costs.
So if somebody's going to buy a campground, and let's say, like I had a situation one time where a client had to buy the campground, but they knew within the first 60 days they were going to have to undergo a sewer improvement. So can they do that all in one loan? Or do they have to wait until after they own it?
That's one of the nice things about the SBA loan program, is that we can finance improvements along with an acquisition. And the fact that we can do construction financing is part of the same transaction as the permanent financing. Typically, if that borrower went to a local bank, they'd have to have 2 different loans, one for construction and purchase and the other one for the permanent financing. Whereas with the SBA loan, we can do it all in one transaction, and we can fund the construction of the improvements and the purchase of park models in draws on that loan as they submit invoices. And then when we finish the construction, the loan is fully funded, and at that point the repayment would start. So we can actually set up the loan to where they don't have any payment requirements until the improvements or add-ons and construction is completed.
Well, that's a great benefit. That's good. So I've also heard that the SBA looks at different types of campgrounds in different ways. So, whether you have a destination stop or an off-the-highway kind of a campground versus a seasonal campground where you have longer-term residents. Can you tell us a little more detail about how the SBA looks at that and what the rules are there?
Yes, I'm glad you asked that question, because that's the first one I always have to ask, and that's to make sure that it's eligible for SBA financing. Because it's a small business loan program, we're not able to offer financing for any type of residential development or project. The reason that we're able to provide financing for campgrounds, and the reason that they're considered a small business, is they fit the hospitality industry classification. Hospitality means short-term rentals. And the way SBA defines that is that the majority of your rental revenue needs to come from transient guests with short-term stays less than 30 days. And that's what makes it fit hospitality. SBA understands that some campgrounds will have monthly rentals people that do stay longer than 30 days. And it's okay if they have a mix of that as long as the majority of their revenues come from the transients.
Gotcha.
So that's going to be 51% or more of their revenues have to come from people that stay less than 30 days.
Okay, so if you were looking at a park, I know this is pretty common out west in Texas, Oklahoma, where they have, workers nearby, pipeline workers and drill and oiling industry people who actually live on site, that probably wouldn't qualify for an SBA loan to purchase that kind of park, right?
That's right. You mentioned Texas. My office is actually in Houston, and so I do get a lot of loan requests from West Texas where there's a lot of oil production. And so most of the residents in those West Texas RV parks are workers, oil field workers, who are going to be staying for longer than 30 days. And so technically, according to SBA guidelines, they're treating that as a second home. It's a residence. And so if the majority of the income is coming from those workers staying long term, it's not eligible for SBA financing.
Got it.
And around the nation, I've really seen a trend with the high cost of housing that more and more people are living in their RVs, and they're looking for RV parks that accommodate that. And so that's why we always have to ask that as the first question to determine if it's an eligible property.
And is that based on what it was or what it's going to be?
It's based on what it's going to be.
Okay.
There are situations where the buyer comes in and actually gets rid of the residents and turns them into short-term rentals. And if the business plan and financial projections and the market analysis justifies short-term rentals instead of long-term, and it's going to be an immediate conversion, that could make the loan request eligible.
Got it.
Awesome. So, what should applicants be prepared to provide when applying for an SBA loan?
There's going to be information from the buyer and information from the seller. From the buyer, it's going to be a personal financial statement, 3 years tax returns, a management resume. There's going to be forms where they fill out information about their background, whether they've had any arrests or convictions or different issues like that we might have to deal with as far as SBA eligibility. On the seller side, if it's financing for an acquisition, we want to see what the income was. And this is a federal small business loan program. So the way the SBA wants us to look at the income is through the seller's tax returns. If they didn't report all their income, we're not going to see it. We're just going to look at the tax returns. And that's how we gauge the cash flow that's available to make the loan payments. If it's a startup business or a business where we're relying upon expansion and financial projections to repay the loan and the historical tax returns don't show enough income, that's possible also. That just puts it in a different category with higher risk. A business acquisition where the business is already demonstrating sufficient cash flow to repay the loan is much lower risk than one where we're relying upon financial projections. And in that case, we're going to need a market analysis, and we need to know who are your competitors, what's your market area, what are their rates compared to your rates, and how do you justify the rate that you're going to charge? What's their occupancy, and how do you justify the occupancy that you're projecting? And do all your expenses line up for the industry as far as a percentage of revenues? So there's a lot more homework if we're relying on projected revenues than if we can see actual historical that was sufficient for the loan payment.
And I could see where that might be hard if you're coming into an area. I've had a lot of people say they're coming into an area where they feel like there's a lot of opportunity because the market is so underpriced. But that can also be a negative if you're trying to come in and increase the prices, but your competition doesn't. So, I can see where that would have to be analyzed a little bit, and you're going to have to provide some additional information about how your occupancy will differ because of those changes if your prices are going to go up too.
And you want to convince the loan committee that you know what you're talking about, that you've based your financial projections on real data, and that you understand the industry. And because a expansion or a startup business has higher risk than a regular business acquisition, our bank has a policy that the borrower should have campground management experience.
And
That's hard to get sometimes because there are a lot of people entering the industry for the first time, and a lot of them have really good credentials.
right.
And so I'm constantly faced with that question, well, what do I do if I want to finance a startup business and I don't have the industry experience? There are a couple of ways that we can get around that. I can ask for an exception to that loan policy with loan committee, and they're going to ask me to justify why that borrower should deserve that exception. And the reason, there are a couple of standard reasons that work really well. If they're approved to be a franchisee for KOA or Yogi Bear Jellystone, we don't have the management experience requirement for a startup or an expansion because we know they're buying into a successful management system. We also know that both of those franchises are highly rated by a company called Frandata that rates franchises for SBA lenders. And we also know what the statistics are on loans to those franchisees. And we know that they both have very low default rates. So that allows us to waive the requirement automatically. Another way we might be able to waive it is if I can prove that the borrower has relevant related management credentials, business management credentials, and they have a strong financial statement. Many people getting into a campground for the first time, this may be their sole source of income, and they may be selling their house to come up with the down payment. That probably is not going to be somebody that could justify a waiver. A waiver of the management experience requirement would require somebody that has other businesses that they've owned and operated successfully, that has other investment assets that they could fall back on if they don't meet their projections as quickly as they've projected, that has other sources of income. Those things all would strengthen the loan application and possibly allow me to get loan committee to justify an exception to the management experience requirement.
And can you give us a sneak peek into this magical committee? I'm picturing like a boardroom of several people and they're ready to check off the list, like this one's a yes, this one's a no. I know it's not that. But what is this magical committee, and where are they? Are they in your bank, or are they with the SBA?
They're in our bank. We are responsible for the performance of our SBA loan portfolio. If we start experiencing too many defaults on SBA loans, we will lose the privilege to make SBA loans. We are routinely audited by the SBA, and they're always looking at the performance data on our loan portfolio. So the people responsible for making the loan decisions are all in-house at the bank. And we are designated as what's called a preferred SBA lender. There are SBA lenders out there that will originate an SBA guaranteed loan, but they can't make the loan until the SBA also approves it, and that's a second round of approval. But for many lenders like Ameris Bank, we have done such a large volume of SBA loans, and our portfolio has been under scrutiny by the SBA for long enough that we earned that preferred lender designation, and that gives us the authority to approve the loan, close it, and service it without involving the SBA. And so that loan committee is going to be one or more individuals within the bank who has the authority to approve a loan for that dollar size. That may be just one person for a dollar size up to a certain amount. And then when it gets larger than that, it might be 2 people. Larger than that, it might be 3 people. But they're generally standing ready to look at a credit memo when I've got one prepared. that has all the spreadsheets, my write-ups, my ratio calculations, everything they need to know about this loan application. I put it into that certain format. I ship it up to them. Everything is paperless, and we're all remote in our work. Our bank headquarters is actually in Atlanta, but none of our loan officers have maybe one or two have offices in our bank branches. Most of us are working remotely from our home offices around the United States. Our bank has branches throughout the southeastern United States, but I'm in the Small Business Government Guaranteed Lending Division that does lending nationwide. So it really works for us to be remote and paperless and do everything that way.
Yeah, so like if you had to list like the 3 most common mistakes you see from applicants, what would that be?
On business acquisitions, many times I see people negotiating a purchase and they haven't seen the seller's tax returns yet. The tax returns are everything to us as the lender as far as a gauge of the cash flow. That's our beginning point. Yes, they may be making projections that show more income and they may justify how they can get there, but we have to start with what was the actual historical performance for the last 3 years. And so when a borrower tells me that they haven't even seen the tax returns yet, I know that they haven't completed their due diligence properly. And they need to do that to determine what kind of payment the business can afford, and then build their business plan and financial projections from there. If it's a startup business, there is no track record. And so that's where we've got to get into the market research and the data on competitors and the demand from the local area and prove up where that income is going to be coming from. So proving up the income is probably one of the biggest challenges on the front end. Let's see, what else?
Let me ask you a question, if I could, on the tax
Okay.
return part, and this may spur your third one. I have obviously seen a few tax returns from sellers that look pretty messed up. I will put it easily. You know, when there's all round numbers and the numbers just don't make sense. If you want to buy that park because you truly think it has the opportunity, but the seller's tax returns are really, really bad, are there any ways around there? Is there something that a buyer can do to work around that?
I think we lost him, but he's coming back in.
Nope.
There we go.
Okay.
All right, re-ask the end of
Okay.
that question.
All right. I'll ask that again. Are you there, Bruce? Okay.
Yes.
So if a seller has really stinky tax returns, they look horrible, they look homemade, they don't look legit, but a buyer still thinks this has some great gold mine opportunity here. Is there anything that a buyer can do to make that deal still work?
There is, and what that does for me, it changes the loan application classification. Instead of treating it as a business acquisition, I'm going to be treating it as a business startup or a business turnaround. And that embodies more risk to the lender, and that's where we start looking much more seriously at the borrower's campground management credentials. That's where we're going to look more deeply at their market research. That's where we're going to rely upon data on their market more seriously.
Yeah, that makes sense. Yeah. Because I've seen a few of those in my day.
So yes, they're much more challenging because I mean the first thought that comes into your mind is, why do the tax returns look like this? Why are they a mess? Is there a reason for it? Is there an underlying reason that there's really a problem in the market and there's really not a need for this campground as it exists? And so it's an extra hurdle to think that you've got a borrower that can actually turn it around.
Yeah, I actually had a case just like this not too awfully long ago, but the seller was an older gentleman who had passed away. Actually, his family was selling it, but the gentleman who passed away did not like to pay taxes, and I'm pretty sure his tax returns would not have passed IRS audit, come out too well. But
Yeah.
they still felt like this, knowing that he was basically hiding and sheltering things from his taxes based on other records that they could kind of show. It looked like it still might be a decent opportunity, but obviously that puts a severe hurdle in their way.
Yes. Yeah. I mean, it really takes it out of the business acquisition. It's like just buying land and improvements. Fortunately, the infrastructure is there for the campground, and so they don't have to build it, but they still have to perform on the loan, and we need to know how are they going to get there.
All right.
Yep. So, how do like EIDL loans? I know we've had a lot of hits on YouTube where we've talked about the EIDL loans and all the stuff going on with that. How do those influence the SBA loan qualifications?
If our borrower, the person acquiring or who already owns the campground and is expanding it, has existing EIDL loans on their campground or on some other business, that is going to be considered debt. And we don't hold that against them. I think anybody that had the opportunity to get an EIDL loan, that's the emergency disaster loan from the SBA, it came with a below market interest rate, like 3%. So it's like you should take that money and you should help build your business with it and help it survive through the pandemic. So we're not going to hold it against them for having an EIDL loan, but there is a repayment obligation, and I'm going to have to calculate that into my debt coverage ratio. Not only do they have to repay our new SBA loan, but they're going to have to repay other debt that they have as well, including an EIDL loan. And we'll figure that into the calculations and make sure there's enough cash flow to do that. Now, if the seller of the business has an EIDL loan, it has to be paid off at the time of closing. And so many times part of the sale proceeds will be taken out by the title company to pay off the EIDL loan so that we can close the new SBA loan.
Awesome. And talking about the EIDL loans, there's a lot of people were really intrigued on YouTube when they were watching our videos about the EIDL loans. The other thing that we touch on a lot is Rob's plans. How do those kind of work with the loans? You want to talk about that for a minute?
Sure, and I know Donna is the expert in this as well, more so than me probably, but the Rob's plan was set up by IRS so that people who have retirement funds can actually take those retirement funds and invest them in their business. So oftentimes we'll see people use retirement funds from a place that they used to work, and they'll follow all the IRS guidelines and invest those funds in the business, and that becomes their down payment, or it may be funds available for working capital to grow the business. And when they do that, they do what's called rolling over the funds, and they do it according to IRS guidelines, and they don't have any early withdrawal penalties or income tax liability from doing that. And so it's a great way to fund a new business.
So do those reduce the amount of the SBA loan, or are they just strictly considered cash down payments just like any other?
Well, the more down payment you have, the less you need to borrow, and so yes, it's used for down payment, or it could be used just for day-to-day operations. One of the things that we look for as a lender is a borrower who has enough cash reserves after making their down payment, a prudent level of reserves for emergencies. And so that could also be what the rollover funds are being used
Gotcha.
for.
Yeah. Yeah, we run into a lot of people looking to use 401k dollars as, and sometimes it's their only means of getting that down payment enough to get into the campground. So,
Yeah, I would say most of the first-time owners that I'm financing campgrounds for, they fund the down payment either by selling their residence, where they have a lot of equity, or from a retirement account that they roll over. Both of those are very common means of raising funds for the down payment.
and while we're talking about the residents, does the SBA have any issue or problem with that fact that now all of a sudden they're going to live on site on the campground land and not own their own home, but it will become part of their home as well?
Not only do we not have a problem with it, we really like it if they live on the campground and they're involved with day-to-day operations every day on site. My particular loan committee at Ameris Bank has a bias in that direction. They believe that people should, if they don't live on site, they should be close by and monitoring operations daily.
And while we're talking about that, it spurs on another question I had for a person who's in process of buying a campground. Part of their funds from their loan, they had a combination of buying the campground as well as some construction costs. But part of their construction costs were actually to build a new residence home on the property because the other one was kind of in rough shape. Does that have any bias one way or the other?
Yeah, that's a good question because that's going to, for eligibility purposes with SBA, we're going to have to evaluate that on a case-by-case basis. You'll recall that I mentioned that SBA does not allow financing of residential
Right.
properties. But if a business is the type of business where it's served by having an on-site manager's residence, then that can be part of the financing. But typically, a manager's residence is going to be something small, like an apartment or a cabin or a park model, something not extravagant. It's for a manager, not necessarily an owner. And so if the owner wants to build an extravagant residence on the property, they probably need to survey that out and finance it separately. And that's not a bad thing because usually financing for residential properties is on better terms than you could get with a business loan. It's usually long-term financing at the lowest interest rate possible for residences.
Yeah, that kind of leads us right into our next question. I was going to ask, how are the interest rates looking now? And are these usually variable notes or fixed, or is there a structure that it works well with most SBA loans, or does it just depend on the particular situation?
As I had mentioned, I've been doing small business lending for over 40 years, and all types of small business loans, whether they're conventional bank loans or SBA loans, the pricing is almost always based off of the Wall Street Journal prime rate. It's going to be a spread over prime. Could be anywhere from prime +1 to prime +3. It is typically a variable rate. With SBA loans, most of the time it adjusts quarterly throughout the life of the loan with changes in prime. The reason for that is that most SBA lenders will sell the guaranteed portions of their loans in the secondary market to investors who want government-backed investments. To sell the loan in the secondary market, it needs to have a rate that's adjustable quarterly. In this unusual rate environment where rates have been rising drastically, we have a lot of loan applicants who are really worried about interest rate risk. And so our bank had to come out with a program to meet their needs. And so what we came out with, and this was only recently, is we are now not only offering loans with the traditional quarterly adjustment on the rate, but we can now fix the rate for the first 3 years, 5 years or 10 years. We believe that rates have gotten to a point to where they're going to stabilize at some point without going up a whole lot higher. We can't sell these loans in the secondary market. We have to keep them in our bank portfolio. And so we have to do balance sheet management with our portfolio. And there's a certain amount of that loan volume that we can put on the books. And we want to help our borrowers protect themselves against interest rate risk. And that also helps us as far as their repayment ability and the potential not to default on the loan. So it's not only good for the borrower that we're offering this, it's good for the bank as well and the performance on our loan portfolio.
Awesome. So, how hard is it to like refinance, especially if like the interest rates go down? Is that going to make it harder, or how hard is it?
Actually, a person that owns an existing campground that wants to refinance is able to do that with an SBA loan if we can improve their terms. That's the requirement from SBA. SBA wants us to do what's good for the small business owner. Typically, improving their terms it's not necessarily going to be lowering the interest rate. Most of the time, it means extending the term of the loan, because they've got short-term financing either with a seller that they bought it from, or they have short-term financing with the bank. And they want to convert that to long-term permanent financing for 25 years. And we can do that with an SBA loan. Yes, there are some situations where we may be able to get a lower interest rate for them. But in most cases, it's extending the term is what's going to be the biggest advantage, lowering their payment requirements, making more cash available to grow the business.
Great. And, speaking on the loans, I had one other question related to the EIDL. We talked, I know if somebody has an EIDL and they're looking for additional funds, those two loans can work together. They don't have to refinance out of the lower interest rate. They can keep that one and do additional financing, right?
Yes.
Okay. On the other side, let's say that the seller has an EIDL loan. I know there's been some question, and we really haven't seen much come out from the SBA yet, but the seller has to have the SBA's written permission to sell their assets. And I know, obviously if they're going to sell it and pay off that whole loan, that shouldn't be an issue. But have you seen anybody go through that actual process and get that written information from the SBA?
No. What we do is we just make sure that EIDL loan is paid off at closing or prior to closing. And that satisfies the regulation.
Okay. Because I know there's
if the seller has an SBA loan, it has to be paid off if the buyer is using SBA financing to buy the business,
right,
because the seller won't have that business to generate the cash flow and repay the loan anymore.
Absolutely. My question relates in general, the rules about the EIDL where the SBA has to give permission. Technically, if they wanted to sell a tractor that's secured by the EIDL loan, they're supposed to have written permission from the SBA. And I've not heard of anybody being able to get such a thing, or I haven't heard of many people trying to attempt to do that, because they know it's kind of like a never-ending process, and you probably wouldn't be able to get it. That's why I was just curious.
Which is typical for most small business lending. Anytime a borrower wants to release collateral, why would a lender want to release collateral on their loan?
Yeah.
I mean, it will weaken their position. And so the only reason they might want to release the collateral for the borrower is if there's a reason. For instance, that tractor is no longer needed in the business, but there needs to be a negotiated release. And usually the negotiation is going to mean, well, whatever money you get from selling that tractor needs to pay down the loan.
But what if they're buying a new tractor because the old tractor doesn't work?
and that's the difficult conversation, is because,
That's why I was curious, because there's so many restrictions on that, but I never hear of anybody really being able to deal with the SBA to get those kinds of things resolved. Even I've had cases where people have shut down a business and we haven't been able to get anything out of the SBA. We're just kind of waiting for them to ask the question because there isn't really a process, it doesn't seem. But I guess with repayments beginning, they're going to start to figure out people aren't going to repay that, or that business went out of business. But I haven't seen a real process come through yet.
Yeah, one of the conversations I have with people on the front end of a loan application when we're talking about the collateral that's going to be used for the loan is that if there's anything in that collateral package that you're going to need to sell or not have in the future, let's just not include it in the collateral because that would be too difficult to negotiate a release.
Right. Yeah, it becomes a bureaucratic process, a nightmare.
Exactly. Yeah. I agree.
Well, this has been some great info.
All right.
I'm excited for people to hear it because I know this is answering a lot of the questions that buyers have and sellers too.
Yeah. So how should the listeners get in touch with you if they want to work with you? You get a website, an email, a phone, any sort of contact information you want to put out there?
I do have a website. It's my name, BruceHurta.com. And all my contact information is there. So that's Bruce, HURTA.com. My phone number, 281-384-2595. And my email address is bruce.hurta@amerisbank.com. And Ameris Bank is spelled AMERISBANK.
Awesome.
All right. Well, that's a wrap. Thanks for joining us. And we'll hope to probably have you back on at some point, as the climates change across the world and the campground industry evolves. More questions have to be answered. So we'll hope to have you back as a guest soon.
Thanks a lot, Bruce, and look forward to seeing you around the blocks and on some deals soon, too.
Well, I hope that more of my borrowers will take advantage of services like Campground Accounting offers. It makes me feel a lot more comfortable when I know that they're getting good advice.
That's awesome, and we love to help them make sure that is a smooth process and streamline those little hiccups right out of the way. Awesome.
Well, I look forward to working with you more in the future.
Same here. Thanks, Bruce.
Yeah, same here.
Well, thank you for having me today.
Thank you. Bye-bye.
Yep.
Thank you for listening to Campground Compass. I'm so glad you joined us. Check out the show notes and more of our seasoned advice at campgroundcompasspodcast.com. While you're there, be sure to explore the archives for previous episodes. And if you never want to miss a single audio adventure in 4-season business growth, subscribe to this podcast here and on YouTube. If you like what you're hearing, please consider leaving us a positive review on iTunes. It would be very much appreciated. Friends on social media, check us out on Instagram and Facebook at Campground Compass. Until next time, stay savvy.